Thank you for checking out Fieldman Rolapp Associates Municipal Market Update for the week of May 31st, 2022. This is our 36th posting. We typically post around the middle of the month. Fieldman Rolapp Associates is a municipal advisor to government. My name is Adam Bauer, and I serve as CEO and president of Fieldman Rolapp Associates. On our first slide, we focus on recent business headlines. A lot has changed in 3 quarters. If you go back to fourth quarter of 2021, we just started seeing some inflation, and maybe we started seeing some of that in third quarter of 2021. But I'm not sure anyone was real concerned about it. We heard a lot of talk about it being transitory, it being supply chain driven, and that once we could solve some of the supply chain issues, that inflation would come down. Then the calendar turns and you get into first quarter of 2022. And then we see the consumer price index show that there really is a lot of inflation out there. And I showed you a chart last month where we saw the inflation just really ramp up in that first quarter of 2022. And so now there starts to be some concern that inflation is not just transitory. So I think that word transitory starts to fade away in the first quarter of 2022. Now you get to the second quarter of 2022 and you hear a lot of articles or a lot of headlines about recession and can we control the inflation? And we've heard things like stagflation, oil prices being high, housing prices being a lot higher, wage pressure. There's been talk at both Amazon and Starbucks about union votes. And so let me just give you a few headlines that don't deal with some of those types of things, but more of the macro economy. So this is from the Wall Street Journal, May 19th, 2022. Recession fears drive down stocks. Then just a week before that, from the Wall Street Journal's May 12th, 2022, there's inflation, but it's ticked down a bit to 8.3 in April. One thing I found very interesting about this article is they broke it down by geographic region. So if you're in Phoenix and Atlanta, you're feeling inflation big time. Phoenix was at 11.6, Atlanta 10.8. Now you go to New York and San Francisco. New York has 6.3% inflation, and San Francisco has 5% inflation. What I found pretty interesting about these two areas is these two areas have pretty regularly had increases in home prices. And so the folks in New York and San Francisco probably are not noticing that much of a difference with price increases. And then when you look at Phoenix and Atlanta, those folks are feeling it much more. So really, depending on where you live, you are noticing this inflation in a much greater fashion than you might otherwise know. And then we look at rising rates cool off home sales. This is May 20th, 2022. And one thing I found interesting about this is it's not quite what we were dealing with during the Great Recession, but it certainly is a change. Long-term rate lock for home buyers. So this was the articles referencing that home builders are working to lock in rates for a longer period of time to create certainty for homeowners. And then also some are looking at doing ARMs, where they adjustable rate mortgages versus 30-year fixed mortgages. So nothing should really surprise us about this when you see rates going up. But I think what you're seeing though is using financial tools to get into homes versus more traditional type mortgage. Then finally, on May 26th on CNBC, on the TV station, there was a news clip on housing red flags. So all these things are really the second quarter of 2022 that we're seeing. And now we'll get into some of the numbers and how things have changed since we last posted. So last month, I showed this chart from the Bloomberg for the first time, and it was really the 30-year mortgage rate. And when I showed it last time, we're at that absolute peak there to the far right. And hopefully what you're noticing is we've come off of that a bit. So we got up above that 5.5 and it now has ticked down. It looks like somewhere close to around 5.3. But hopefully what the takeaway from this slide is just that dramatic increase. So these are folks that are using mortgages to buy homes. And so now their cost of borrowing has gone up quite a bit. If they were buying at the end of December, they would have been below that 3.5 number. Whereas if they're borrowing now, they're above 5%. So likely either one, putting more money down, looking to use a ARM to buy their home, or buying a smaller home than they originally expected to. So this is the 10-year treasury, and I've also used this as our bellwether to kind of monitor how rates are moving. And you saw that big jump around January, and I'm going to show you this, how this compares to municipals in a later slide. But that was a big jump, and then continues to go up, and then hopefully what you're noticing, a lot like the mortgage rates, it has stabilized or ticked down just a bit. So the last week has felt a bit calmer for those of us who monitor this closely and certainly enjoy low rates along with our clients. So hopefully this trend of not increasing as much continues. Now, this is a chart I've shown you, excuse me. This is a chart that I've shown you almost every MMU. And what we're showing here is the bar charts represent the range of municipal interest rates going back to 2005. That red line represents as of 5/25/2022. And so what the MMD is a municipal market data yield curve, and that is our benchmark for what each one of these maturities would trade at for that day. And so hopefully you see there's 30 data points, and it changes every day or has potential to change every day. And the AAA is the perfect credit. It's the highest rating that you can get. And so you're seeing now, going back to 2005, we're probably at about average interest rates or just a little bit lower on the longer term. When I started doing this, that red line was kind of scraping the absolute bottom. And when I started doing this was April of 2020. So rates have really gone up. Well, if I would have showed you this, or I did show you this in December, that red line was not at the absolute bottom, but it was near the bottom. All this movement upward has happened since the beginning of 2022. So what we're trying to show you on this chart is just kind of how the MMD and US Treasury have traded compared to each other. And what I was mentioning earlier, I'm going to try to find one that shows this well. If we go down to this 20-year, this is your 10-year Treasury, and or 20-year Treasury. It shot up, and then the municipals did not catch up until later. So the Treasuries went up, and then municipals followed, just a bit later. And you see that trend throughout all these different yield curves here. But you have the 5, 10, 20, and 30-year MMD compared to the US Treasury yield curve. Put it all on one slide so you can just generally see how they've all trended. The shorter term rates have gone up in a greater fashion than the longer term rates. Another thing that I thought was interesting to share with you is that credit spreads have been increasing. So the AAA would have a 0 credit spread. And then the AA, which is a little bit lower rating than the AAA, there's a gap. Investors require a bit more yield to loan if it's a AA versus a AAA. So we do that for the AA, single A, and BAA, which is equivalent of the BBB. And so the dark, it looks like a blackish line, is the spread, the yield curve for the BBB. And hopefully what you're noticing is that has trended upward in a greater fashion than the others. And what I think we're seeing here is investors are looking to have higher credit quality in their portfolios. And we're seeing this with outflows of funds. While I show you the aggregate outflows in a slide or two, we're hearing from the underwriters, when you break it down, that there's been a greater outflow from the higher yield funds than there have been from the other funds. And this chart, I think, helps show that, is that investors are requiring more yield for lesser credits. And now I talked a bit about the outflows. Green bars represent money flowing into the municipal bond funds. Red bars represent money flowing out. Hopefully we are toning down on the outflows. Looks like we're seeing like maybe a bell curve here. Hopefully something like that happens, because this is meaning that we have less demand for municipal bonds, which tends to drive up interest rates. Good news is we haven't had that much volume. So we've had less demand, but we have not had that much available for investors to buy. These lines that you see here represent the last 3 years and the average weekly volume. And these bar charts are the weekly volume going back to April 25th. But generally, if you look at anything but this May 9th and April 25th, you're seeing we're kind of on the lower end of the weekly volume. And so once again, that's really important because in economics, we all learn about supply and demand. I've already showed you that demand is down. And so the fact that supply is down helps interest rates not go up more than they already have. So we're showing you now the economic and holidays that are before us. That Memorial Day was yesterday, so that's behind us. But we do have all these items that all of us will continue to monitor. And really what to focus on here is if these come in dramatically different than they've been projected, then the market will likely react to that. Our last slide, I want to once again share with you the registered municipal advisors from Fieldman, Rolapp Associates. Any one of our team members can answer other questions or give you more detail. But I thank you for your time, and I look forward to talking with you again mid-June. Thank you.